I seem to keep getting the same question right now, and that is the market too expensive to invest in right now? Let's just imagine that you were the worst investor alive. Every single month from May of 2024 through November of 2025, let's say that you bought $1,000 worth of Palantir at the absolute highest price each month, at the absolute highest peak, and the worst possible price that you could have paid for that month. No choice of cherry picking in the dips. Instead, you're just buying the top 19 months in a row, making your investment at $19,000. That horrible investment style would have been worth roughly $43,000 today, or 126% return, on the absolute worst possible timing strategy in the world. Over that same time period, the market would have only given you a 21% return. Palantir, even though it was bought at the absolute worst price every single month, it returned 6 times what the S&P did. Now recently, Palantir released Q1 earnings where revenue grew 84.7%, beating expectation on every single line. But the stock dropped 6% the next day. Does that even seem to make sense? What company can beat every expectation in front of it and then drop the next day? So then it makes you wonder, has it reached its peak? And to answer that, you have to zoom out. I mean, way out. Here's the bigger picture. Last year, in the first half of 2025, US GDP grew at 0.1% annual rate once you strip out AI data center spending. That means that data center investments drove 92% of all countries' growth in the first half. That means this is an AI economy, which means that the real question for investors isn't whether you're paying too much for these names, it's whether sitting out of this growth cycle ends up being one of your biggest regrets. And the reason that I've been able to see a lot of these trends coming from way out is because this is exactly what I used to do for a living. Before I retired, I was an executive at companies like Amazon and Target, where I managed categories like men's apparel and toys. My team and I had to find the trends a year in advance, and that skill set translates straight into my investing strategies to always look ahead. So today, I'm going to walk you through how I'm investing in this growth cycle right now to set myself up for the next several years. And here's a perfect example about trends where the news dropped just a few weeks ago that Palantir is bidding on the air traffic control program. And here's a video clip of mine from a year ago. Now, I am going to drop a speculation bomb on this video, but I find it intriguing that Palantir recently partnered with Archer Aviation. What if, and I realize it's a big if, Palantir uses this as a test bed for something much bigger? What if this is just an opportunity to upgrade the US air traffic control systems with their Foundry capabilities? 12 months later, almost to the day, the FAA shortlisted Palantir to build the AI tool that's going to modernize US air traffic, and it's a $32 billion program. My off-the-cuff speculation became the shortlist, and that's my trend forecasting in action on the exact type of stocks that we're going to be digging into today. For those new to the name, Palantir builds software that takes massive amounts of data and turns it into real-time decisions. They have Foundry on the commercial side and Gotham for defense and intelligence. I first covered them back in 2023 at $15 a share, and I've kept coming back ever since. Now, 2 years ago, US commercial revenue was $150 million in a quarter. Today, it just printed $595 million. That's growing 133% year over year. A 4-fold increase in 2 years, with commercial now growing 1.6 times faster than the government segment. And that's the accelerator that you're going to need to pay attention to. And here's the margin machine. Once Palantir is inside an enterprise, ripping it out is essentially impossible. Foundry takes months to deploy across financial systems, supply chain, manufacturing, and government databases. Once it's running, customers renew and they buy more modules. The technical term in software is net dollar retention. In plain English, that means existing customers buy about 50% more from them every year. In November 2025, the stock pulled back about 30%. But over the same window, operating margins expanded over 1,500 basis points, and the commercial customers count grew 31%. So let me get this straight. The price came down, the fundamentals kept compounding, and the gap closes a little bit more every single quarter. Eventually, one of two things is going to happen. The price catches back up to the fundamentals, or the next earnings print makes the math obvious enough that institutional money has to chase it. Regardless, both outcomes are going to end the same way. In a nutshell, that's Palantir. Now let me walk you through 6 other names that are sitting at this same setup across this AI economy. We'll start off with Applied Digital, a specialty data center developer purpose-built for AI workloads. Most data center companies are diversified across cloud, enterprise, and AI. Applied Digital builds just one thing: AI factory campuses engineered for the densest, most power-hungry compute in the world. In April, they announced their biggest lease yet, a 15-year deal with an investment-grade hyperscaler worth $7.5 billion. It pushed their total contracted lease backlog past $23 billion. They also just spun off their cloud computing business as a separate company called Chronoscale. Applied Digital still owns about 97% of it, and the split lets the AI cloud business and the AI real estate business each scale on their own terms with different capital structures. So Chronoscale might be worth putting on your watch list. Getting back to Applied Digital, the primary tenant has been CoreWeave at Polaris Forge 1 in North Dakota, and the April lease adds a second investment-grade hyperscaler at a new campus. This campus design is liquid-cooled with ultra-high-density compute racks built next to standard natural gas, where power is cheap and the grid has a lot of capacity. The push is to scale this AI factory model from 600 megawatts of contracted capacity to over 1,000 megawatts in the pipeline. Applied Digital's market cap sits at roughly $13 billion, but their contracted lease backlog tops $23 billion. The company is priced at less than half the value of the contracts that are already signed. Every company tied to AI infrastructure, the data centers, the power plants, the chip fabs, they all depend on precious metals. And that brings us to today's sponsor, Canadian Goldfields Discovery Corp., a pure-play gold exploration company in northwestern Ontario's Miminisca-Fort Hope Greenstone Belt. This region has produced over 200 million ounces of historic gold from Red Lake, Timmins, and Hemlo. The Miminisca Gold Project sat through 2 different gold cycles untouched, while every other neighbor got developed. Mineralization is confirmed at both ends of a 14-kilometer system. The gold sits in banded iron formation, or BIF, ancient layered rock where gold runs in continuous, predictable bands instead of scattered veins. This BIF runs through the 12-kilometer corridor between those zones, never drilled with modern systematic methods. BIF is one of the most reliable gold hosting formations worldwide. Same setting as Musselwhite at 6 million ounces and Homestake at 44. With no debt, $4.5 million in cash, permits in hand, and a 10,000-meter drill program set to launch, Canadian Goldfields Discovery is ready for business. The team brings pedigree from K92 Mining, Ivanhoe Mines, and BHP. And really, ownership tells the rest. Roughly 30% with board and management, 30% with institutions. So that's 60% of the float is in strong hands. So let's see, they have a pure gold play, a tier 1 jurisdiction, a BIF system with 12 untested kilometers, and 10,000 meters of drilling starting right now. That's the setup that early stage investors really look for. If you'd like to learn more about Canadian Goldfields Discovery, please check out the link down in the description. Next up is Credo Technology, a semiconductor company specializing in moving data inside AI data centers. Most semiconductor news focuses on the chips themselves, like NVIDIA's GPUs or AMD's processors. But Credo doesn't make those. They make the connections between the chips, active electrical cables, optical digital signal processors, and the high-speed interconnect that lets thousands of GPUs in a data center talk to each other fast enough to actually work. In April, they announced a $750 million acquisition of a silicon photonics company called Dust Photonics. The deal vertically integrates Credo's high-speed signaling expertise with silicon photonics, and management is now guiding optical revenue alone to exceed $500 million in fiscal 2027. Their customer base is the hyperscalers, Microsoft, Amazon, Google, and others. Microsoft used to be 86% of revenue. That number is down to 42% as the rest of the hyperscaler base ramped up, which is meaningful diversification of customer concentration. That's good. The technology is power efficiency. Credo's optical signal processors run at 30 to 50% lower power than competitors at the same speed, which matters when you have hundreds of thousands of GPUs in a single building, all needing to talk to each other. The push is the Dust Photonics integration, the move into co-packaged optics, and ramping their 1.6 terabit optical platform, the highest bandwidth interconnect commercially shipping today. Credo's revenue grew 201% year over year, with a PEG ratio of 0.9. That's the highest growth rate of this list at the lowest growth adjusted price. Now we move on to Amphenol Corporation, the picks and shovels layer of the AI build-out. Amphenol doesn't make chips or run the cloud. They make the physical connectors and the high-speed cables that link everything together inside a data center, with the same products serving autos, aerospace, and mobile, but the AI side of the business is really what's accelerating. In April, they reported record Q1 results, with the IT Datacom segment generating virtually all its organic growth from AI applications. Orders hit a record $9.4 billion, up 78% year over year. The book-to-bill of 1.24 means orders are coming in faster than they can ship. In January, they closed a $10 billion acquisition of CommScope's connectivity and cable solutions business, which gives Amphenol coverage across the full data center signal path: high-speed copper, power, active copper, passive fiber, and active optics. They're no longer just connecting chips, they're connecting everything that moves data inside of an AI factory. The technology is custom engineering at scale, which is why they keep winning sole source contracts on these next-gen GPU racks for specific hyperscalers. For them, the push is owning the entire data center signal path and capturing the growth in AI-driven cabling density. A typical GPU rack now uses 2 to 3 times the interconnect length of a 2024 rack, and that ratio just keeps climbing. And now we'll move on to the next company on the list, which is Meta Platforms, the parent company of Facebook, Instagram, WhatsApp, and Threads. For investors, what matters is they're the second largest digital advertising business in the world, sitting in front of roughly 3 billion daily users. Meta is on the list because the stock is down 23% from its recent high of $796 back in March. While the price was getting cut, the business was doing the opposite. Revenue grew 33% year over year, and operating margins expanded over 800 basis points in that same window. The technology behind it is the AI-powered ad targeting layer that they had to completely rebuild after Apple's privacy changes completely broke their original tracking model. But they figured out how to predict ad relevance using their own first-party data and on-device machine learning, which is why advertising revenue has accelerated, not decelerated. Meta had pretty much cut the Reality Labs budget and delayed the next mixed reality headset, pivoting hard into those Ray-Ban AI glasses. And that bet sold more than 7 million frames in 2025. AI glasses are the actual wedge into the next consumer device category, and they're betting hard on it. For their size, Meta's PEG ratio sits at 0.93. So for context, at the end of the day, the stock pulled back 23% while every fundamental is just getting better. Next on the list is ARM Holdings, the company whose chip architecture powers virtually every smartphone in the world. As a reminder, ARM doesn't manufacture any chips. They license the design to companies like Apple, Qualcomm, Samsung, and nvidia, who pay ARM a royalty on every chip that's shipped. And that's exactly why their gross margins look more like a software company than a semiconductor. Well, quite honestly, their margins are probably better than anybody's. In March, ARM announced something that breaks their 35-year-old business model. They're going to sell chips directly to customers for the very first time. The product is called ARM AGI CPU, and Meta and OpenAI are committed customers, with production expected by the end of 2026. To me, the bigger story is underneath this in the data centers, because we have AWS Graviton, Google Axion, Microsoft Cobalt, and NVIDIA Grace all run on the ARM's Neoverse architecture. ARM has effectively become the standard for hyperscaler compute. The best part of their technology is power efficiency. ARM-designed chips run cooler and use less electricity than competing architectures, which matters as much in your phone as it does in a data center running hundreds of thousands of AI accelerators. The main drive for them is to move into AI-specific compute. ARM split the company into 3 new business units: Edge, Physical AI, and Cloud AI, and it's launching their first proprietary chip alongside the legacy royalty business. They're going from licensing the design to actually selling the product. And ARM's data center royalties just doubled year over year with a 97% growth margin. I mean, they're the true definition of printing money because it's just a royalty business and they're growing just as fast as everyone else. And the next name on the list is Teradyne, a semiconductor equipment company built directly into the AI chip production line. Once again, now Teradyne doesn't make chips. They make the test platforms that every chip has to pass through before it ships. They make the equipment that determines whether the NVIDIA GPUs or the AMD CPUs actually work before they ship them. In April, Teradyne reported Q1 results that beat expectations on every metric. Earnings per share grew 241% year over year, with AI-related demand making up nearly 70% of their total revenue. And their reward for this? Well, the stock fell 19% on the news. It's the same pattern as Palantir, Meta, and the rest of them that are on this list. But of course, since then, the stocks have gone up and down multiple times. As for their customer base, they happen to be the entire AI ecosystem: TSMC, Samsung, NVIDIA, AMD, all of the hyperscalers, and all of the memory companies. And their CEO describes the demand in 3 different stacking AI waves. They've got general purpose data center build-out, inference optimized silicon, and edge AI. And they just so happen to be positioned for all three of those. The technology is test platforms specifically designed for high bandwidth memory, the kind of memory that sits right next to every AI accelerator. Their Magnum memory tester gives them a lead in HBM testing that competitors are still trying to catch up to. Their drive is to expand into AI data center connectivity and test software. They just invested $157 million in a joint venture called Multi-Lane Test Products and acquired a software company called Test Insight, adding capabilities for testing AI infrastructure from end to end. So that's 7 names across different layers of the AI economy. You've got software, real estate, semiconductors, connectors, chip design, and test equipment. They all happen to be completely different businesses, but they all work towards the same setup. Each one beat expectations on their last earnings report. Each one has a multi-year strategic growth sitting right in front of it. And on most of them, the stock either dropped after the beat or pulled back from a recent high, even while the underlying fundamentals just kept improving. And that's the gap that I keep talking about. The gap between what the market sees in the moment and what the math says about the next 5 to 10 years. If you go back to the question that we started with, is the market too expensive to invest in right now? My answer is the same answer that I gave you 12 months before the FAA shortlisted Palantir for air traffic control. Look at what these companies are going to own in 5 years, not necessarily what all the pricing action is doing today. The trend forecasting lens is what earned its keep when I bought into Palantir 2.5 years ago, because I was trying to look at what it was going to be in 5 years. And it's the same lens that I'm using on these 7 names today. But even then, I try to find pullbacks for every single entry, where dollar cost averaging for a long-term investor like me is just the same boring game plan I go to every week. As always, thanks so much for watching, and we'll see you next time.